Howdy, Jacob here. Today we're going to do an in-depth video on BRY Corporation. So to remind everybody, I got to a price that made it look like a screaming deal with my preliminary assumptions. However, after looking through their quarterly reports and annual reports, I have come up with new assumptions that I believe to be more accurate and specific to Beer Corporation themselves. However, first I want to go over some of the notes that I took out from reading their reports and financial statements. And so the first was a big old positive in that 27% of the market cap was returned to the shareholders through dividends and share repurchases in 2022. So that is a massive number. That would be a great return on any investment. However, you have to understand that that was, in my perspective, based on the numbers, a very positive year for them. And so they were able to send out, almost $200 million in their what's currently a $550 million market cap. But keep in mind that the market cap's I guess over here 515 just because it went down, and then enterprise value of 970, 970 million. Some of the wording of the CEO said, "quote Moreover, we are aggressively pursuing scale through accretive mergers and acquisitions, especially outside of California, where they are based. In all cases, to enhance our ability to generate sustainable free cash flow." So I love, if you watch my last in-depth video, I love when they talk about free cash flow. That's fantastic because that's the lifeblood of the business. That's going to be how they truly produce cash from all of their operations after spending all of their money on capital expenditures to keep their business open. So I love that they're trying to generate sustainable free cash flow. Now it's just reviewing what they're actually doing with that excess free cash flow to see if it is seeing if they're talking the talk or truly walking the walk. So cash and cash equivalents is 17.2 million with 450 million in long-term debt. So that's why their enterprise value is way greater than their market cap, because their net debt is fairly substantial in the case on their balance sheet. However, if you look at cash flow, they produce fairly consistently over $100 million in free cash flow, which is less than 5 years to pay off their long-term debt. So that's not something that I truly worry about. And then you'll see, if you look at their results on revenue, that there's big increases and decreases due to on their oil and gas sales derivatives line. And so just want to confirm that revenue will look very volatile quarter over quarter due to derivatives. And they're just taking the market value price of that derivative. It's not necessarily the gain or loss on the sale of the derivative. This is just the current market value to lower volatility on their sale of gas and oil prices. So that needs to be kept in mind and understood, that revenues are going to fluctuate quite a bit due to the price of gas and oil, given their current hedges with derivatives. And so next note I have is depreciation and amortization of all of their property and equipment is well above their capital expenditures. And so we can see that they're producing 150 million, 140 million in depreciation, and that's well greater than the amount that they produce in capital expenditures, which shows why their free cash flow. Obviously, there's other parts of free cash flow that go in from net income, like working capital, change in deferred tax, stock-based compensation. But a big part of the reason why their free cash flow is greater for the most part than their earnings, which I prefer that way. And then this is just a note that they have a fixed quarterly dividend of 12 cents. And then depending on their free cash flow, they have a variable amount. And they have share repurchases up to 190 million, which is fantastic because that's I don't know why I'm not doing this in Excel, but roughly 37% of the market cap left in share purchase authorization. So that's great. They've made one acquisition recently, and this was $70 million. And here's a quote by CEO: "We acquired McPherson Energy because their assets are high quality, low decline oil producing properties and are a natural fit with our existing rural Kern County portfolio." So this is again them saying that they're trying to expand beyond California through mergers and acquisitions. And also from the sentence, what I understand is that a lot of the oil producing properties that they will be purchasing are negative revenue producing over the long term. And so, although they might gain revenue from acquiring these companies, if you look at year over year, the exact same companies, you should be expecting mid single digit declines. And so, this is just a quote about what they're doing with their 2023 free cash flow. So, use of cash flow, specifically in 2023, the annual cumulative allocation of adjusted free cash flow is intended to be 80% to debt repurchasing, stock repurchases, strategic growth, acquisition, and then 20% in the form of dividends. And so that's why we see they have their fixed dividend of 12 cents, and then depending on how they spend their excess free cash flow through buying down debt, buying back shares, growth through acquisition, they will use the um, remaining 20% on their variable dividend. And this just says derivatives are measured at fair value. I already pointed that out above. And so let's get to my tweaks and assumptions. So here I'm saying that mid single digit internally, the business as a whole is going to decline. However, through their acquisitions, they might gain 1 to 3% on revenue there. But because I'm assuming mid single digit growth, I am still, for the whole business, assuming 3% decline in revenue, just because, again, it's been so high recently that it might drop a bit more in the short term and then probably steady out to where it's almost negative growth, where the mergers and acquisitions are going to almost outdo the decline in the actual businesses themselves. I just narrowed the margins a little bit. Initially had 10 and 20% margins. I'm now going to do 10 and 15%, just because, again, these are declining businesses. They're going to have to write off a lot of the property, and it might not be able to produce as much, which would lower their margins. And so that's why I have their free cash flow margin down a little bit. Share change, I don't dislike -1%. I think that's fine. They still have a lot in their authorization. And just want to note that they're spending so much on their dividend currently. So they probably won't use too much of their free cash flow to buy back shares. Terminal PE, I went down a lot because it's a declining business. And so with the declining business, you're definitely going to need to lower your expectation for terminal PE and price to free cash flow. And here you can see I have a 7 PE in free cash flow. This is not unreasonable for a business that I think through M&A is still going to be declining 3% a year. And then I kept 15% yield because I don't see why I need any excess return. And so when I plug this in, I get 28% decline. However, I do think that because they have the 20% of their excess free cash flow in a variable dividend, I do think instead of cutting it into third, they cut it into half. If we look at what that payout would be, we're seeing about 50 million. So that would be about half of their free cash flow is going towards their dividend, and then the remaining half is going to be to buy down, pay down debt, buy back shares, and make acquisitions. And so I feel pretty good about this. And so with these current assumptions, I'm saying that the stock would have to fall another 20% to give me a return of 15%, given these assumptions. But to me, this is a dividend yield screener. And so this company is definitely, even with cutting the dividend in half, is going to be looking at a 7% yield. This is something that I would put on your list if you love dividends and getting excess free cash flow. This would be one that I would definitely be looking at. So thank you. I hope you enjoyed the in-depth review of BRY Corporation.